Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Joel Groen. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show. CME Group, Trading Technologies, FTSE Russell, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on futuresradioshow.com. Today I spoke with the Chief Investment Officer at 3i Capital Advisors, Joel Groen. We discussed statistical modeling, how Joel has a statistical approach with a fundamental overlay and a macro lens, why he believes in trading multiple asset classes, his advice to traders that want to get into statistical modeling, and last but not least, the importance of developing a mental and statistical edge. So without further ado, let me take you right to the interview with Joel. Joel, tell us a little bit about yourself and how you got started trading futures.
So I got a degree in political science, which is of course useless, but I went to work selling bonds after undergrad, and then decided that I would prefer to be trading bonds or trading different instruments, and went back to graduate school and was given an opportunity to trade futures and futures options in Europe after graduate school. And so that was the goal of going back to school. And so I jumped on that and began my trading career there.
Interesting. What year was that?
Began trading in 99. So it's been about 20 years since I started trading the German fixed income curve.
Talk to us a little bit about your style of trading.
My style of trading is surrounding the volatility markets and the movement in those markets, implied volatility and realized volatility, and how they interact with different assets. So ultimately, we're looking at statistically modeling where future movement will be and how big that future movement will be, which currently we apply in equity indexes, currencies, commodities, and fixed income.
Are you guys point and click trading? Is this all automated?
We are point and click, for lack of a better term. We'll enter orders throughout the day, but they are not time sensitive.
Okay, so statistical modeling, you're putting the orders in manually. Can you just give us a little bit more insight on your overall process?
So the process is we have a variety of volatility-based models and statistical models that look at technical indicators, ranges of markets, and we will put in different orders based on what our models are telling us and where we see the most opportunity. It is not systematic, but it's rather discretionary around those models. So we'll ultimately have signals that are generated from our models that we will either ignore or trade on, depending on the opportunity and depending on where we view the macro components within the market and what we see as future potential events as well as risks to the market.
Obviously, you have a lot of experience. You've been doing this for 20 years. Did you always trade this way? And if not, why is this the way you trade now?
It's a good question, Anthony. I began trading for a group that always believed in having long option positions. So they would always look for potential outlier events, black swan events to make money. What I found was that that style of trading is very effective when there's a lot going on and it's very active markets. But when markets are calmer, that can be very difficult to make money. In fact, you tend to lose money. So then after a couple of years trading with that type of mentality, I went to work for another group, and one of the head traders of that group was a firm believer in selling those types of events and being taking advantage of the 99% winning type of trades, which are great until something goes wrong. And so those two strategies were very, polar opposites. And so when I began trading on my own in a prop trading relationship, I found that I would do both. I would use both strategies in a diversified way, where you end up being long and short and looking for relative value opportunities. And as we did that, I began trading in hundreds of different stock options, and we found that the idiosyncratic risk was difficult to deal with. And so we eventually, through trial and error, found that the best markets to trade this style and have the relative value approach were futures markets and futures options markets. So we migrated that all the different lessons we'd learned and brought them into the futures and options markets.
Can you share with us how the strategy works? Maybe give us a trade example.
Sure. One of the trades we'll look at is crude oil. So we're constantly looking at the implied volatility levels or forecasted volatility of the crude oil market. And that can be generally in a number of different time buckets, but we spend most of our time, or we're focused on 3 month term options, where we believe you have an opportunity to monetize both expensive and cheap volatility pricing. So we'll look in the crude oil, we'll look for options that are expensive, and then we'll look at our models, which show us the projected range of crude oil using both fundamental and technical analysis. And then we can do something as simple as creating a strangle opportunity or a strangle trade, where you sell calls and puts if it's expensive, and if it's cheap, then you can do a different type of trade, which is a straddle trade, where you buy both calls and puts. So we'll look at both of those types of trades in the crude oil market, and then size them based on where we expect crude oil to be going in the next 2 to 3 months.
Are you using any technical indicators? And if so, which ones are you using?
Yes, we're essentially using moving averages in different time frames to assess where we see ranges and potential movement in different markets. And some markets we use more sophisticated methodology. For example, the equity market tends to be upward biased with more sharp downside volatility. So you have to model that slightly differently.
So far, everything sounds very basic and simple in your thought process, which I love. But can you maybe just dive in a little bit deeper and share with us some of the details within your strategy that help you make a trade decision?
Sure. So the way I described it is probably too broad. I would say ultimately we are using statistical models to identify opportunities in those different markets. What we tend to do is have about 5 different trades on. So we will have a crude oil trade, a S&P trade, a VIX trade, a nat gas trade, a euro trade, and then potentially one or two other trades, depending on where we see opportunity. And what we start with is our deep modeling knowledge of implied volatility levels, so derivative pricing. So we look at options and whether they're cheap or expensive, and we try to keep it simple. So we'll do option strategies that are very basic and have either a straddle or a strangle. And then we'll trade futures around those option strategies to hedge and to also look for relative value opportunities. So, for example, which is something that I would think many traders can understand, is we'll buy S&P straddles when they're cheap, and then we may buy and sell VIX futures as a hedge or a relative value opportunity around where we see those straddles being priced. So we can buy options and then trade futures around them, and then sometimes we'll sell options in a contained way, and then trade futures around those. Hopefully that's a little bit more concise and understandable description of the strategy.
It is. Thank you very much for sharing that with us. How many markets are you trading your strategies in?
So we trade equity index markets. We trade S&P, NASDAQ, and Russell. We'll trade VIX futures markets alongside those, quite frequently paired with them. We'll also trade currencies, where we trade major currencies, not emerging market currencies, so euro, yen, pound. We trade commodities, which are the more liquid types of commodities, so energy, which is crude oil and nat gas. We also trade precious metals from time to time. And then we'll trade in the fixed income market, depending on what the opportunity is and where we think volatility levels are. So those are the markets we trade, and then we're not. It's a statistical approach with a fundamental overlay with a macro lens to it.
Hey everybody, I want to take a moment to thank one of our sponsors, FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-mini Russell 2000 Index futures, contract symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. Okay, so it's a statistical approach with a fundamental overlay, and you're using, like you said, a macro lens. I get all that, but I'm just curious. It seems like you're trading everything. Why are you trading so many markets?
Yeah, we trade most markets, and the reason we do that is because we are limited to essentially what I would almost compare to a macro strategy uh, based on the major types of assets out there. We used to trade equities, single name equities long ago, and found that was um, less ideal. And so, in order to get a more diversified approach, we want to trade the different asset classes in sort of a on a global basis.
Are you just entering your orders for the day sessions, or are you trading at night as well?
We do not trade at night. We're specifically trade during market hours, partially for sanity reasons, but also because uh, liquidity is not always there at night.
Nope, and I've caught myself in some doozies overnight, to say the least. Um, Explain a little bit more about how you're using the macro lens, as you put it, in your strategies.
Well, I think ultimately we identify opportunities statistically, and then we'll use a macro lens, which we would sort of combine the fundamental and technical factors into that macro lens. And so I would say that all strategies have macro exposure or exposure to forces that are outside of their own models. And one of the I guess maybe most obvious or most interesting examples that I've seen in the last several years is the divergence from value investing in equities. So value stocks have really vastly underperformed names like Amazon, and I think one of the realities of the current market conditions is that Amazon and other big tech names have considerable momentum in terms of gaining market share in their business. And so the old sort of value investing and looking at the accounting type of measures are less relevant. And so I think without recognizing what's happening in the markets, you can be, I guess, blindsided or distracted or miss what's really happening. And so going back to our strategy, what I find is that if we are saying, oh, well, the British pound has really been quite volatile, and so we think from a modeling perspective, there's no reason for that. And we completely ignore the fact that Brexit is occurring and there's all sorts of fundamental reasons that are driving volatility. And quite honestly, there will be even more volatility going forward. Then we're using a statistical model in a way that's ineffective at best and dangerous and likely to lose money. So our macro approach is, I guess, putting a little bit of logic, common sense, and other factors into statistical modeling. Because at the end of the day, if you rely 100% on mathematics in a modeling perspective, I believe that you're missing part of the picture. And I'm sure there are people that disagree with me and that it's all incorporated in their models, but I have been unable to build the perfect model that's always predicting that. So that's why we use the macro lens on our statistical modeling.
Yeah, going back to why you said earlier, this is why you point and click, and this is why you're using some of your discretion because of your experience, recognizing themes, looking at the overall picture. Am I right in that?
That's well said, Anthony. better, more succinctly and better said than I did. Yes, but that's exactly right.
So the other day on Twitter, I said this. I said there are two ways to develop an edge. It's great to have both, but in my experience, not everybody will have both. And one edge that you can develop is mental. The other edge you can develop is statistical. What do you think about what I said?
I think it's really hard to develop an edge. And I think the expectation of many investors that there is a consistent edge is challenging at best. And one of the best ways to develop an edge, I would agree, is statistical. One of the benefits of the statistical approach is that you can be more comfortable with the probability of a positive outcome. So I would argue that there are always ways to find a statistical edge. It's evolving and changing. The mental side of it, I would say, is harder to measure and harder to calibrate the probability of success with. Nevertheless, if you combine the two, I think you have a real potential to outperform other strategies. There are two different pieces to the puzzle, and I think both of them can create edge. I think ultimately you want to have both, but you can implement either in a variety of different ways.
Yeah, exactly. So for me, I said on the tweet, I said I never really developed a statistical edge. Yeah, I had a great strategy that worked for me, but if I automated it, I don't think it really would have amounted to much. The edge I had was the execution of it. Going back to what you said today, was using my discretion, understanding the overall theme in the market, my execution, trading it bigger here, smaller here, or today's not a good day for my strategy. And I've always felt that the best executor will get the most out of any strategy. The strategy itself matters, but the way you trade it is what really matters.
Yes. So I think to piggyback on your comment, one of the things that I've noticed is when I was getting into trading, I traded with a lot of very smart people that had PhDs and went to extremely competitive schools and were very bright. And I found that the brightest people often weren't the best traders. And part of that is because going back to what you said, the strategy itself or the smartest person may not be able to trade it as effectively as someone who has good trading acumen. So the edge to a particular strategy or a particular mind may be less effective than an effective trader.
Last question before we get into rapid fire. For all the traders out there listening to this that are interested in statistical modeling, what would you recommend to them to be their first step?
In terms of statistical modeling, I would figure an area of the market that you're interested in and a type of model that you think might be interesting. So I found that mean reversion is something that makes a lot of sense to me from a logical perspective, that frequently in life in a lot of different ways, things tend to gravitate towards a mean. And in the markets, there are certain types of markets that have mean reversion activity or mean reversion behaviors. So one of the reasons that we trade the products that we trade is that there tend to be long run mean numbers that we can base our analysis on. For example, volatility models and derivative pricing eventually has to converge to what is actually happening in the market. So there's a convergence to a mean, or convergence to an actual behavior within the market, which gives it what I would say is a academic backdrop that enables you to make decisions with a higher confidence level than, say, something where you're trying to statistically analyze a trending market without using, multiple different types of analysis on it.
Jill, great stuff, but we are not done yet. We have rapid fire questions next if you're ready for those.
I am ready. Fire away.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You can try it now for free at tryttnow.com. Joel, first question for you. What trader has influenced your life the most and why?
John Meriweather. Great mind, great trader, lots of success and lots of failures. And we can all learn from, I would say, learn from his hubris. That's probably one of the greatest lessons you can learn from him.
What was one of the hardest things for you to overcome in trading?
Emotion, no question. It's difficult to lose money, and it's hard not to think you're brilliant when you make money. And those two things are counterproductive from the emotional perspective on trading. So keeping a level head is always difficult, always a challenge.
How has your trading process evolved over the years?
I would say that I started in one style, moved to another style, and then have tried a variety of different statistical models. And at this point, feel like I have a lot of different tools to use in the workshop, the trading workshop. So it's much more opportunistic and able to take advantage of the always changing environment.
What is one attribute that you believe every trader should have?
I would say that curiosity is the attribute you need. You need to figure out what's happening in the market and how to make money with it. And if you're not curious about it and what are the factors driving it, then you won't figure it out.
Favorite book about trading?
Favorite book, Natenburg on volatility trading. It's not cool, but it has a very balanced approach. For more interesting read, I always loved Liar's Poker because it was such a great sort of introductory view of trading.
If you could pick one profession other than trading, what would it be?
Philosophy professor. That's the dream, right? Sit around and chit chat about the logic of everything and not have to ever be right or wrong. It's great.
What's the best piece of advice you've received about trading?
Best advice, I would say, be patient and always try to understand that the best trades frequently take time.
If you could go back in time and give the younger you a piece of advice, what would you say?
I would say that you want to build relationships with traders, other traders, and also investors and have a broad network of people that you're in conversation with. It's a tough business, and it can be very lonely when things aren't going well. So it's good to have a community of traders, investors, and other people that are living a similar life, because it's not always a fun one.
If you had an elevator pitch me your edge in trading, what would you say?
I would say our edge, or my edge, is the integration of statistical models with macro forecasting.
Last question for today, Joel. What's your favorite thing to do when you're not trading?
Favorite thing to do is to spend time with my wife and sons. We play a lot of sports and we travel, and I love competition and I love traveling, and so those are things that I try to do as much of as I can.
No social media and no website, Joel. When are you getting on Twitter?
I will get there eventually. I'm trying to become more social media conscious, but at the moment I'm behind the curve, that's for sure.
Joel, this was so awesome. Thank you so much for coming on Futures Radio Show today.
Thanks, Anthony. I really appreciate it. It was a lot of fun, and hopefully, everyone can get something interesting out of it.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.